Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Understanding tax in real estate can actually make you money. And with our tax deadline in the rearview mirror, today we're going to talk about upcoming changes on the horizon and a few things you may still be able to do for 2022. Plus, we've got a great guest on the Real Estate Guys radio program. Hear ye, hear ye. Registration is open for the Real Estate Guys 21st Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year is the editor of the Gold newsletter, Brian London, real estate developers Beth Clifford and Victor Monash, and Jim Rohn's 18-year business partner, Kyle Wilson. Also back from Peak Prosperity, Dr. Chris Martinson, and the rebel capitalist, George Gammon. And joining us live and in person for his 11th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet. It all begins June 6th in beautiful Ambergris Caye, Belize. Visit Summit on Sand to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to summitonsand.com and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 21st Annual Investor Summit on Sand. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. In the co-host seat, it is our financial strategist, Russell Gray.
Hey, Robert.
We love real estate because it's a way that we can make money and we can own assets and we can build wealth over time. And there's some real advantages to real estate, and it's certainly not the only investment, which is why on this show we talk about broader picture economics and the bigger levers in the economy. But this time of year is when people start thinking about that looming tax return deadline. And once you're a real estate investor, you realize that taxes aren't the enemy. You can use the tax code in a brilliant way if you know what you're doing.
Well, I think the thing a lot of people don't really think about is tax as a line item in their expenses and something that they need to manage just like they would any other operating expense. And when you approach it that way, then you can realize there's a return on investment when you take the time to invest the time and effort and advisors and everything you need to do to bring your tax bill down. That's real return on investment because there's no escaping the tax except for using the tax code in the way it's intended. So think about GE. I read years ago that GE, big major corporation, had 975 full-time people in their tax mitigation department. And you think, well, God, what is their payroll for 975 full-time people? Well, whatever it is, it's less than their tax bill, which is why they do it. They make a profit on that expenditure.
Right.
Do they wish they didn't have to do that? Yes, but they can't control what the tax code is. They can only control how they react to it. And so if businesses are making those kind of investments in order to make a profit on mitigating their tax, then a full-time real estate investor, a part-time real estate investor, a high-earning net worth individual probably ought to consider taking that same mental approach towards their taxes.
Well, absolutely. And yet most people just operate under the premise that, well, if I'm going to earn a lot of money, I'm going to pay a lot in tax, and that's the way it is. And they buy one of those computer programs and figure out their tax obligation, and they're off to the races. The minute you get into a little more complex tax return, which usually happens when you do something like invest in real estate, then you start to notice that there are all kinds of ways to structure your investment that it's beneficial to you. And again, I think the big premise is the reason we'd like to limit the amount of tax we pay is so we can put more of those dollars to work. And the government's not dumb about this. They know that if we do that, we're going to end up with more assets, maybe employees, additional income, and eventually they will get the tax. But when we start out, we think, I don't want to pay tax, I don't want to pay tax. I think that's letting the tax tail wag the investment dog.
Well, we say all the time, how you think and what you believe affects what you do, and what you do affects the results you produce. If you believe that taxes are necessary and unavoidable, or even more, you think, hey, I love paying tax, and God bless you if you're one of those people. But if you believe those things, then you're not going to take a proactive approach. You're not going to seek out the help that is available to you to be able to reduce that tax. You're not going to do the math about the tax savings. You're not going to think about the compounding or the negative compounding of paying tax and losing the earning power on that capital versus keeping the tax money and reinvesting it and compounding its growth. So how you think about it mentally is probably the first and most important thing. And then the second part that goes along with that is how you think about your advisors. And my dad taught me this very early in business. He said, Russ, your accountants and your lawyers are technical advisors. They're not business advisors. Now, they have business perspective. You want to have somebody who understands business and investing and thinks like a businessman or an investor. But at the end of the day, they're there to provide you the technical advice so that you can assess and understand the rules of the game, the risks that you're planning on taking, and then you as a business person or investor are going to make a risk versus reward strategy. And sadly, so many accountants and tax advisors are very conservative. They're playing a safe game. They're trying to keep not only you way out of the range of trouble, but they're also trying to keep themselves out of trouble. And the challenge is that if you are using the tax code properly and keeping your records properly, then it's a hassle to get engaged with the IRS. Nobody's going to say you don't want to, that getting audited isn't bad or it isn't, that it's fun. However, an accountant who is really willing to stand behind their work is going to be more aggressive in using the code the way it's written to help you to mitigate your taxes. And so the thing is, you need to work them. You need to work with them. You need to tell them, hey, this is what I'm trying to do. Instead of saying, can I, it's a how can I? And there's just little subtle things. And here's the other thing. Tax professionals are not commodities. I think a lot of people think, they're a dime a dozen. And I think that's probably true in a lot of cases, meaning that there's a certain level of practice. But when you find a really great tax strategist, somebody that really understands your business, thinks like an investor, thinks like an entrepreneur, and is willing to be creative, to think, how can we get this done? Well, we still work well within the confines of the code. You've got something, a relationship really worth taking care of, really worth developing and investing in.
One of the benefits to real estate are the tax benefits, and yet we often say on this show, Russ and I are not tax professionals, but we have one with us today. Our guest is certified public accountant Tom Wheelwright, and he knows tax. He loves tax. He's one of the few right-brained accountants. He'll have you excited about tax before the end of this show. He's also the best-selling author of Tax-Free Wealth and his new book, The Win-Win Wealth Strategy. When we come back, you'll meet our good friend, CPA Tom Wheelwright, today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
For thousands of years of human history, silver has been recognized as money. Then in 1965, the United States took silver out of the financial system. But did silver stop being money? Smart investors don't think so. And ever since, when there are concerns about the quality of the currency, alert investors seek shelter in silver and gold. As the size and frequency of major financial crises grow, silver is attracting a lot of attention. To help better understand the what, why, and how of silver, watch the free 9-part series, Making Sense of Silver. Everything you always wanted to know about silver but didn't know to ask. Featuring 30-year precious metals veteran Dana Samuelson. Send your email requests to silverseries@realestateguysradio.com. Whether you own silver now or you're wondering if it's too late, email silverseries@realestateguysradio.com.
Hello, this is Robert Kiyosaki. I'm the author of Rich Dad, Poor Dad. And if you're serious about learning how to invest in real estate, listen to the Real Estate Guys. They really know what they're talking about.
Welcome back to the Real Estate Guys radio program. Now in our 27th year of broadcast, we talk all kinds of topics related to real estate. And today, one of the most important things is taxation. And to foster that discussion, give us some updates and some news, and see if it's still okay to squeeze out a deduction or two for last year. Let's welcome back to the Real Estate Guys radio program, best-selling author, CPA Tom Wheelwright. Hey, Tom.
Hey, Robert. It is great being with you and Russ today. Thanks for having me.
Always good to have you on the program. And when you come out to our live events, we appreciate that. You know, people don't like to focus on tax, but one of the things you point out is that most of the tax code actually isn't about taxing people. It's about giving them deductions.
It is. Most of the tax code is a series of incentives. And the question is, what does the government want to incentivize? What do they want to encourage? And all you have to do is say, okay, where does what I do from an investing standpoint fit within what the government does? And can I do it in such a way that I get the maximum incentives that the government has to offer?
And that's really the point, is figuring out what are those incentives and where does it intersect. And of course, over the years, we've had you talk about the tax treatment of things like, oil and gas and new construction and the various accelerated depreciation and cost segregation and all those things. But I think the premise starts with understanding how the tax code is built so that as a real estate investor, you know what to go by, because it can vary.
Yeah, it really can. So first of all, the tax code promotes business first. So the more you operate your real estate activities like a business, the more you not only get real estate tax benefits, but you get business tax benefits. And I think it's that compounding. And remember, now we've got the tax law incentivizing solar energy and alternative energies. Well, where do you put that solar energy? You put it on a building. And so, you start looking at all of these incentives and they compound on each other. And that's really where you start paying very little tax.
Now, if you're listening on the radio, then you're hearing the most current version of the show. If you're listening to the podcast and it just released, then we're right here in the middle of April 2023. So we're right upon the tax deadline. Some of you have already filed or filed your extensions. But if you're listening later, people go back in the archives and hear shows, just know that tax law can and does change. But I think first thing, Tom, is, 2022 is in the books. So a lot of tax moves are kind of frozen. You can't necessarily make those moves. But is there anything someone can do as they're getting ready to think about getting all their information to their tax professional, if they haven't already, that they can still do for 2022?
Yeah, absolutely. Actually, one of the big things in real estate that people don't understand mostly is that you can do a cost segregation now on real estate that you acquired last year. So you didn't have to do it when you first bought the real estate, as long as you do it before you file your tax return. And remember that getting an extension on your tax return is not difficult. It's a very simple form to file. And so you can actually extend all the way to your personal return, all the way to October. You can extend let's say you've got a partnership return, a business return, you can extend that to September. So you've still got some time here to do that cost segregation, which, as we've talked about before, is the single biggest tax benefit in real estate.
Well, and quickly, for folks that don't understand, it's the idea that not every component of a property depreciates over the same life, how long something would last in a property. And so maybe just give us the high notes on why we like cost segregation so much.
Well, so basically, think about when you're buying a property, you're really buying four things. You're buying the land, which never wears out, so you don't get a deduction for that. You buy the building, which wears out over a very long time. Like residential, they say it's about 27 and a half years. commercial 39 years. So that's slow. It's good depreciation, but it's slow. But then you've got land improvements, things like the landscaping, things like the outdoor lighting, the covered parking, things like that. And the IRS says that that's 15 years. Well, that's a lot faster. And then you've got what's inside the building, like the cabinets and the flooring and the ceiling fans and the window coverings. Well, that pretty much wears out in anywhere from 5 to 7 years. But what's cool about 2022, and this is why you really ought to do it for 2022, is that 15-year and 5 to 7 year property, you get to deduct in 1 year. So instead of having to wait for 5 years or 15 years to deduct the depreciation, you get to deduct all the depreciation in the first year, which can have a huge impact on your tax bill.
Well, sure can. And a lot of folks have been driving towards that, right? That accelerated depreciation provision. And that goes away in 2023?
Well, it goes down. So it goes from 100% to 80%. And then 2024, it goes to 60%. And then it keeps going down to zero.
So I don't have to have done the cost segregation. I say I acquired a property, midway through last year, as long as I do it before I file my return.
That is correct. You've still got some time, but remember, the cost segregation experts, they're getting busy.
They are.
You're going to want to get on this and get your place in line so that you can get that cost segregation done by the end of the summer.
Yeah, and we say don't try this at home. You can't really do this on your own. You need two folks. You need the specialist who's going to go out and physically look at the property and come up with the percentages of the property that are 5-year, 15-year, et cetera. Then you need your tax professional involved too. Is that correct?
Yeah, exactly. Actually, the IRS in their audit guide on cost segregations specify very clearly that you have to use professionals for this, that if you do it on your own, they're going to disallow it.
All right. So there's one. That's an awesome one for real estate investors. And most of the cost segregation specialists will walk you through whether or not it makes financial sense. You pay something for this study. And if it's not going to at least give you that much benefit, you're probably not going to bother doing it. If I'm buying a $40,000 dilapidated house in the middle of nowhere, probably doesn't make sense. If I'm buying a 200-unit apartment building, it absolutely makes sense, but your cost segregation specialist will help you work through that. What else for 2022 might we consider as we're preparing our taxes for that year, Tom?
Well, another one is remember that your business meals, which includes meals with your banker, your attorney, your accountant, your customers, your investors, those are still deductible 100% for 2022. So you want to make sure you have your documentation. We like to say at my company, Wealthability, we say if you have a pretend documentation, you get a pretend deduction. So very first thing the IRS asks for when they come in, when they audit you, is give me the documentation. You need to prove that you qualify for the deduction, because the general rule is no deductions. So you have to prove that you're an exception to that rule. So that means for meals, you need the receipt. You need on the receipt, it needs to say basically who, what, when, where, and why. What was the discussion about? Who'd you meet? Why'd you do it? Unfortunately, time date stamp is on there already, so you don't have to write anything, but you really should do that. And then actually scan the receipt and keep that receipt, because remember, we got 87,000 new IRS employees coming on, and your chances of being audited for 2022, I think, are far higher than your chances were for 2021.
And it is easier than ever to, snap a picture of that or make sure you have a digital copy somewhere. And then, it's quite possible that you would be audited for past years. So how long should folks keep that documentation, Tom?
Really, you should keep it for 7 years. That's the IRS's recommendation. That's our recommendation. The IRS really only has 3 years. States typically have 4 years. But because your documentation might affect something else, let's say, for example, you bought real estate, and then let's say 5 years from now, you sell that real estate. Well, you need that documentation for when you sell that real estate. So you want to keep it. First of all, you certainly want to keep documentation for as long as you own the property, and probably for 7 years after you sell the property. So, the 7-year rule is great for things like receipts. But if you're talking about your HUD-1 for buying your real estate, probably ought to keep that for another 7 years after you actually sell the property.
All right, good stuff. Hey, anything else that folks ought to be thinking about in terms of the year that's in the rearview mirror?
Well, the good news is you actually have 3 extra days this year. The due date is April 18th, not April 15th. For some states, California and parts of Georgia and Alabama, the due date is in October. And you don't even have to file an extension. In California, you even get an extension to pay.
Wow.
Yeah. So first time in my lifetime that California actually has provided some serious tax benefit. And that's because of all of their natural disasters they had last year. So they're allowing you that extra 6 months to get things together in California, and the IRS is agreeing with that. They're allowing you also that extra time. So you do have a little bit of extra time, but also remember, I always like to encourage people to remember that an extension is a really easy thing to do. Here's what you don't want. You don't want your tax preparer preparing your return at 11 o'clock at night.
That is super good advice. That's seat knowledge right there. Good stuff. All right, let's transition a little bit and think about what is changing. So before we're done, we're going to ask you about the new changes, the tax law, things like the 80% we just discussed in 2023, but also we'll morph into proposed changes and what might happen. Last time we had you on the show, you talked about, just the tax changes that happened when the new administration came in. If we're thinking now a little further along, okay, how I'm going to structure my income and investments during 2023 and beyond, what things should we be aware of there, Tom?
Well, of course, the whole bonus depreciation decline, we need to run the math. We actually need to schedule out 5 years and say, well, look, it's 80% this year, but then it's 60%, then it's 40%, which means that you kind of have to start loading up on property, right? Because you're going to get it slower. Remember, though, that if you're getting something over 5 years, if you buy something every year, by the 5th year, it's like you're getting 100% because you're getting the same amount because you got 5 times that 20%. So I do think that we need to schedule out better. So that's the big one, is scheduling out your depreciation tax benefits. Another one, though, is last year, as I mentioned, we had 100% deduction for meals. This year, it's back to 50%. So you're not going to get that big deduction for taking, your business buddy out to lunch this year that you had. Now we're back to the old rules where you only get 50% deduction.
Yeah, but because inflation has raised prices everywhere by double, it's really the same amount.
Yeah, there you go. Right. So, great.
But that is important, right? Because, and again, back to your idea of keeping the records of this, a deduction is a deduction, and half a deduction is better than no deduction.
Well, that is absolutely true. Another thing that's changed actually for the positive in 2023, of course, is the solar energy credits. Those have gone up. Interestingly enough, at the same time those went up, the actual electric car credits really went down. So we don't think of them as going down, but because they apply to so many fewer people now, but I'm going to give you a little tip on that one?
Yeah.
So remember, we've got this income limitation on solar, on electric car credits. But if you lease a car, you don't have that limitation. So because you don't own the car, and so it's the dealer gets the credit because there's an exception for dealers. So the dealer gets the credit and they'll pass it on to you. And so if you lease a car right now, I will tell you, there's a lot of reasons, tax reasons, to lease a car instead of buy a car. And I think that's a big change, a big shift. And one is it's an electric car, that $7,500 credit. But another one is bonus depreciation doesn't apply much to cars, right? You get a little $10,000 bonus depreciation, $8,000 bonus depreciation. It's not very much unless it's a big truck. With a lease, you get to deduct all of your lease. I mean, there's a little bit of add back, but it's really small. So if you're spending $1,500 a month on a lease, that's probably a bigger tax deduction than if you bought the car. And so just remember, and the other part of that, of course, is that the residual value now is pretty much true value for most cars. And so lease it for 3 years and then buy out the residual value. And then you get your tax deduction for the 3 years. Then you decide you want to buy it. Great, buy it. Now you get the advantages. And you could even get some of that additional depreciation when you buy it.
See how much fun tax planning can be? This is good stuff. All right. Any other changes that you think we need to know about that are in the books for 2023?
Those are really the big ones. Oh, there is one more, actually, that's very important, and that is conservation easements. So one of the things that people have done with real estate is instead of develop the real estate, they said, well, look, we'll put an easement on it, which prevents it from being developed, and we'll donate that easement to a conservation organization, and our investors will get a deduction for the difference between the value before we put the easement on and the value after we put the easement on. Well, that sometimes has been 4 or 5 times the investment. That's been a really big tax benefit for people. With the budget bill in late 2022, they changed the law, just prospectively, just going forward. So beginning 2023, they changed the law so that no longer can you take 4 or 5 times. You're limited to 2.5 times your investment, the investment in the land. Now, I make just one little clarity here. Historically, people have been used to, if they put $100,000 in, they got a deduction of upwards of $500,000. Well, now they put $100,000 in, you say, well, it's limited to 2.5 times. So that's like $250,000, right? And the answer is wrong. It's actually 2.5 times the cost of the land, not the amount of your investment. So if they're setting a whole bunch of money aside for legal and tax issues and other things, okay, that doesn't qualify. So it may be that you're putting $100,000 and your limit is $150,000 because your part of the property might only be $50,000, even though you put $100,000 into the deal. That's actually a really big change, I think, that I've not heard people talking about, and that people need to be aware of, is that conservation easement tax benefit has been seriously curtailed.
Our guest today is bestselling author Tom Wheelwright. He wrote a great book called Tax-Free Wealth, which is mandatory reading around the Real Estate Guys tribe. His latest book is called The Win-Win Wealth Strategy. He talks about 7 investments that the government will pay you to make. We'll talk about a couple of those when we come back. And we'll play real estate trivia where you can win an autographed copy of one of Tom's books next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number 1 zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, I'm Mark Victor Hans. You're listening to The Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you haven't yet signed up for the 21st Annual Investor Summit, it's time to do so. Just a few spaces remain, but you can join us in beautiful Belize for an amazing week you'll never forget. Get all the details by sending an email to summit@realestateguysradio.com. Summit@realestateguysradio.com. We've got CPA Tom Wheelwright with us today. We're just past the tax deadline unless you filed an extension, and Tom's sharing some great ideas with us. Before we get back to the interview, it's time to play Real Estate Trivia. Your chance to win a prize by knowing today's Real Estate Trivia question. Send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. We'll need your name, the answer to the question, and your mailing address, so that if you're the first to get it right, you'll get an autographed copy of the best-selling book Tax-Free Wealth by Tom Wheelwright. That could be yours if you know today's real estate trivia question. Last week we talked with George Gammon and we asked this: how many U.S. states have changed their state capital? Well, believe it or not, half. Yeah, 25 states have changed their state capital at some time in their history, but the most recent change was Oklahoma in 1911. Here's our real estate trivia question for this week. Speaking of states and taxes, how many U.S. states do not have a state income tax? You have all the states. How many do not charge income tax at the state level? You still pay federal tax, of course, but how many states don't have state income tax? Just looking for a number. If you know what it is or you just want to guess, send your best guess to trivia@realestateguysradio.com. Give us your name, your guess, and your physical mailing address so we can send you an autographed copy of Tax-Free Wealth. That's today's real estate trivia question. We've got the author of that great book with us, Tom Wheelwright. And Tom, you love to talk tax, I know, but you also pay attention to what's coming down the road. So you don't have a crystal ball, but what you do have is your feelers out there. So maybe just get the listeners acquainted with some of the things you're hearing, knowing that this isn't concrete yet. But what do you see coming down the line tax-wise that we might want to be concerned about?
Well, let's talk about President Biden's proposals that are coming through in his budget.
Yeah.
We're seeing some major tax increases. Now, they're not going to happen unless he's reelected in 2024, right? Because remember, we've got this split Congress and the Republicans aren't going to let these bills go through. But if he gets reelected and the Democrats control both houses in 2025, we're going to get these. This is what we're going to see. First of all, a 5% surtax on small business.
Wow.
Okay. So remember, we've got with President Obama, we had this, what we call Obamacare tax or the net investment income tax, but it was only on passive investment income.
Yep.
And the maximum rate was 3.8%. So it didn't apply to small business. It didn't apply to professional real estate investors. Under President Biden's proposal, not only does he raise the rate from 3.8 to 5%, but he applies it to small business and professional investors. And so that is a massive tax increase on small business. As I like to say, it's another attack on small business, which is coming like every day from the administration, is the attack on small business. The second big one is they're looking at doubling the capital gains rate if your income's over $1 million. Well, you think, but millionaires can afford that. But wait a minute. If you're a small business owner, or let's say you're a real estate investor, and you're putting all your money into that real estate property or all your money into your business, you're not going to sell it and get paid back over 20 years. You're going to sell it and get your cash. Well, it's likely you're going to have over $1 million of gain. So if that proposal were to become reality, well, two things would happen. First of all, it would be an enormous disincentive for business owners. It'd be an enormous disincentive to enter into a business. Second of all, it would probably crash the economy. So the economic effects of that kind of a capital gains tax would be, I think, devastating. Not because it's right or wrong, but because it's a shock to the system, and people are not going to want to sell. They're never going to want to sell. I mean, literally, it would not raise revenue. They've proven that anything over about a 25% capital gains rate loses revenue because people just won't sell their property. They'll do other things with it. right? I'm sure at the same time he wants to get rid of 1031 exchanges because he's already talked about that. Well, if you're going to raise capital gains rates, you got to get rid of 1031 exchanges, else everybody's going to do 1031 exchange, right? So that's a big one. The last thing that's been on his agenda lately has been this 25% minimum tax. And he says it's only going to apply to billionaires. Okay, but we've heard that one before, right?
Right.
Where it only applied to the really rich people. Okay, let's go back to 1914 when we got the 16th Amendment. It only applied to people making multiple millions of dollars of income.
Yep.
It didn't apply to the average person. And it was only a 7% rate. Why not have that tax on millionaires? We need to reallocate that money. That's why people voted for it. And remember, more than half the country had to vote for that.
Okay.
And that's what happened. No employees were ever taxed until 1944. There was no tax on employment on wage income. And now wage earners pay all the tax. So, don't believe for an instant, it's like we say that, don't let the camel put the nose in your tent.
Yeah.
Because pretty soon the camel will be in the tent and you'll be out.
Couple of good points in there, right? You mentioned earlier the idea that the tax code is a series of incentives, and we navigate through those incentives so we decide how to run our economic lives. And what happens when there are major tax changes is people figure it out. Individuals do, businesses do. I know your clients do, right? Because you're paying attention to it. And so to your point, the study about when they raise the tax higher, there's this threshold. It's the same in general, right? That no matter what happens, high tax rate, low tax rate, 28%, 90%, no matter what the government's take is, their slice of the pie always seems to hover around that 18 to 20% number. So our mission as investors is to figure out for right now with what's going on, and this is why we ask what's coming down the road so we can be ready, how do we navigate through that? So this isn't to be an alarmist and say, oh my gosh, rates are going up a ton. It's so we can be prepared so we can make those pivots.
Yeah, that's exactly right. And that's where you really want to make sure that you're getting good education, not just good advice, but good education from your tax professionals and the team that you have around you. That team just becomes more important when you have major tax increases being proposed.
Well, two important things there. First of all, before we're done, we're going to tell you how to get a free chapter of Tom's book, Tax-Free Wealth, the chapter that he explains how to find a great tax professional. So maybe you have a professional that's been helping you and you've outgrown them because of your real estate endeavors, and maybe they're, a great person, but you're clear it's not the right tax person. This is a great chapter for you. Or if you don't yet have a tax professional. So we'll give you that resource before we're done. But the other thing, Tom, when we first met, you were doing tax returns and helping people, and we probably couldn't have gotten an interview at this time of the year with you. But today, although you still have a few key clients, mostly you do focus on the education side at Wealthability, and not just educating directly to folks that invest in real estate. We love when you take time to do that at our events or on the show here, but you actually spend a big chunk of your time educating other tax professionals. Can you speak to that?
Yeah, I do. We just, Tax-Free Wealth is fortunately very gratefully has been such a popular book that we get a lot of demand. Number one question I get when I speak is, how do I find somebody like you?
Yep.
So we finally decided, well, look, rather than just build a big CPA firm where we could only handle a small niche of clients, let's build a network of CPA firms where we can handle all types of clients, from people just starting out to very sophisticated investors and business owners and entrepreneurs. So that's what we did. We now have, we're up to 65 CPA firms around the US and Canada. And what I do is we do two things. We train them, but we also give them systems. And, to something that, Russ, you said earlier, is that I think it's challenging if you have to rely on a single person. I don't know everything. You have an international tax question? I don't know the answer. But guess what? Somebody in my network does.
Right.
If you ask me a question on pension plans, I don't know the answer. But guess what? I've got somebody in my network that absolutely is going to know the answer. And so, you want a bigger team than just one person is one thing you want. And the other thing is you want to make sure that whoever's on your team is using a system that has been proven to work over and over again. And that's one thing that we've developed over the last 20 years is really a system for reducing tax, because it's not enough. I don't think it's enough to know the law, because the problem is most advisors are transactional. In other words, we ask them a question, they give us an answer. Whereas what we really want is that relationship where they have a system, they're going, well, I'm going to show you how to reduce your taxes every day, every month, every year. And we're going to actually do those projections out and make sure that you're not just paying less tax today, but you're actually paying less tax tomorrow and next year and the next decade.
Love that. All right. So if you want to get that chapter in Tom's book about how to find a great tax professional, and or if you want to be referred to one of the member firms that has been trained in the Wealthability systems, or if you want to find out how to get Tom's latest book, The Win-Win Wealth Strategy, you're going to just send an email to taxtips@realestateguysradio.com, taxtips@realestateguysradio.com, and you'll get all that stuff rushed to you like magic. Hey, Tom, in our final time together today, let's talk about one or two of the investments the government will pay you to make. Just whet our appetite so folks will be sure and pick up the Win-Win Wealth Strategy.
Well, the three of us love the most is real estate. It is, I was just running through some numbers, and even at the 80% bonus depreciation rate, literally the government will pay half of your investment in your real estate. So that means that if you're getting a 15% return on your real estate, you only have to put half the money in. You're really getting a 30% return because the government's putting in the other half the money. So it also means that you can buy twice as much real estate. So that is a huge tax benefit. In real estate right now, still just really one of the best one of the places where the government will literally pay you to make that investment. And then the second one, of course, falls onto real estate, which is the solar energy. If you're in a place like I am in Arizona, or you are in Texas, or you're in California, you're one of these states that has a lot of sunshine, I got to tell you, solar energy, you can actually get tax benefits equal to about 2/3 of the cost of those solar panels and those batteries, which means that if you're only putting in a third, you're tripling your return. So if your return 7%, it's really 21%. And I just put some solar on my office building, and we estimated it's about 22% rate of return on investment, just because the government put in most of the money. So I love it when the government's going to give me money. I'd like the PPP loans, frankly. I thought that was great. The employee retention credit, another great money. But I'll tell you what, taxes are money that they'll give you every year. You don't need a pandemic to get government tax money.
Absolutely. Well, this has been great stuff today. And as always, we appreciate picking your big brain, and we'll look forward to seeing you soon. There's Tom Wheelwright. Thanks, Tom.
Thanks very much. It's been great being with you.
You're tuned to the Real Estate Guys radio program. When we come back, I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from May 5th through 8th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 18 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. There's all types of opportunity in Belize when it comes to real estate investing, including both long-term and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And at Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me May 5th through 8th in Ambergris Caye, Belize as we study the market, learn about sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so you can follow up with them after the trip if the market is interesting to you. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize May 5th through 8th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hey everybody, it's Ken McElroy, and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit on the Sand in Belize coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Hey, if you ever wanted to have more influence, more ability when it comes to sales and all the great things that happen when you learn to sell, you got to come out to How to Win Funds and Influence People. Once a year, Russ does a 2-day workshop that is amazing, and it's only once a year. So if you want to get better at your persuasion skills and closing your next sale, come out to How to Win Funds and Influence People. All the details on our website at realestateguysradio.com under Events. Well, tax may not be the most interesting thing, but I'll tell you what, Tom Wheelwright always makes it fun.
Sure. Well, I've said for years, as you well know, that do the math and the math will tell you what to do. And more recently, the math is the path. And it's really important just to understand that, you know, if you're going to be an investor, if you're going to be a business person, you're going to have to do some math. You're going to have to calculate return on investment. And you have the gross number, and then you have the risk-adjusted number, which is where your business sense comes in. Is this enough return based on the type of risk I'm taking? Well, with the tax code, the risk that you take when you push the envelope a little bit is the risk of audit. But if you're well within the code and you are properly documented, then it's not that much risk. And then you have to compare that to what could you do. For example, if you were to do a cost segregation, I have a friend who just did this. She did a cost segregation and she was able to literally save $300,000 on her tax. Not tax savings, not tax deduction, but tax credit. And there's a difference. A deduction is just how much you get to reduce your taxable income.
Yeah.
But a tax credit is how much you reduce the amount of tax you need to pay. And so a tax credit is way more valuable than a tax deduction. So when we worked down and did all the math, it was a $300,000 tax credit. Well, that's a property.
Yeah.
And then when you buy that property or pair it with debt where you're buying even more property, and of course, when you get the debt in an income-producing property, you are purchasing not just the property and its future appreciation and its tax depreciation schedule, but you're also purchasing its stream of income. And that stream of income does the debt service. And so you get to write off the amount of the property that is controlled by the debt in addition to that's controlled by your equity. But when you start doing the math on the compounding of that investment over time, and that's where this bonus depreciation, this accelerated depreciation is really fantastic, because instead of spreading the deduction out over 5 years, 15 years, 25, 30 years, whatever the number is, you're pulling it all into the present, and then you're marrying it to debt to acquire more tax breaks and more income and more appreciation. And when you understand the compounding, and it does take a little bit of math, it's you work with somebody who knows how to help you do the math. But when you do that, it is really, really powerful. And you can see why it inspired so many people to get actively involved in investing. Of course, that's reflected in a lot of the pricing we've seen in real estate shot up during the last several years when these tax incentives came. Now we're entering into a period of time where things are going on sale, interest rates are high, and you have to ask yourself, well, if I were to pay a little bit more in interest to purchase a property and its depreciation schedule, but I were to use the tax breaks that I'm going to get as a way to justify the greater interest expense, it may not be as bad an investment as it seems at first blush. So again, the math, do the math, and the math will tell you what to do, and then the math is the path.
Big thanks to Tom Wheelwright for sharing his great ideas and information with us. You can find out more and get that free chapter of his book on how to select your best tax professional. Just send one email to taxtips@realestateguysradio.com, taxtips@realestateguysradio.com. Happy to have Tom at our Secrets of Successful Syndication that just happened. There's another one coming up before the end of the year if you want to come out and meet Tom in person. And big thanks to Tom for being our special guest at our most recent Investor Mentoring Club meeting this week. If you haven't heard, this is a great way to stay connected to excellent and timely information and resources.
Yeah, for those of you that don't know the history with Robert and I, we started way back in the early 2000s doing a monthly meetup in Silicon Valley, and it grew from just 9 people to nearly 1,000 people. And we would meet for 3 hours, and we would teach on a topic, we would discuss a case study, we would have live interactive Q&A with subject matter experts, and you got a chance to talk with fellow investors and build relationships. And it was immensely popular. And we put that on hold 10 years into the program so that we could concentrate on some other projects and develop the radio show nationally. We started podcasting and developing our syndication training program. But with everything going on in the economy right now, in the financial system, with the currency, geopolitics, and there's so much change happening so fast, and so many young people coming into investing having never experienced what happens when the system resets or breaks, we felt like it was really important to start this thing back up again. So we did, and it's a little bit different. We do it virtually, and then we encourage people to get together and meet locally and talk about the things that we cover. So because we've been at this for so long with the Real Estate Guys radio show, we have some of the best relationships in the business. And so we've already had Dr. Chris Martenson come out, Tom Wheelwright's coming out. As the club gets bigger, we're going to be including more and better faculty members, and of course growing this thing out. We're already operating in 7 cities. We'll be in all kinds of cities all across the country over the next couple of years. So learn all about it. Just send an email to imc@realestateguysradio.com. You'll get all the details, and we'd love to see you participate in the next Investor Mentoring Club.
Tax is an important part of understanding your portfolio, and real estate has a ton of tax benefits. Keep that in mind. And until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.